going to do this problem because it kind of goes through the entire buying, using, selling a truck. This is problem 9.5b, so if you want to go into your study tools and select your ebook and print out 9.5b, or just do a screenshot of this particular problem. So notice the double declining balance of a method of depreciation is being used, so that'll be important when I get there. So I purchased a delivery truck for $24,000 in cash, so I debit delivery truck and credit cash for $24,000. Completely fine if you do truck. I paid the garage $900 for changing the oil, replacing the oil filter, and tuning the engine on the delivery truck. So now I have to ask myself 3 questions. 1, does it significantly increase the value of the truck? $900 out of $24,000 is a no. If it had, I would debit delivery truck and credit cash for $900. Second question, does it significantly increase the useful life of the truck? Now, don't read it like if I don't do it, it will significantly decrease. I want to know if changing the oil this one time significantly increases the value of the truck. If so, I would debit accumulated depreciation and credit cash for $900. The third possibility is it just maintains the truck in its current working condition and benefits the current period. So I change the oil several times a year for a truck, so this one just benefits the current period, and since it benefits the current period, I debit repair expense and credit cash. You can put truck repair expense or repair expense. I would just put probably repairs and maintenance expense. Now I record the depreciation on the truck. Its useful life of the truck is 4 years with a residual value of $4,000. If I were using straight line, I would take the cost. My cost is $24,000. Note that if I had debited delivery truck for the $900, my cost would be $24,900. But I didn't, I debited expense. So my cost is $24,000 minus my residual value of $4,000 divided by the life of 4 years, so that's $20,000 divided by 4 is $5,000. That's straight line. However, double declining balances method is used. So under double declining balance, I take 1 divided by the life times 2. So my life is 4, so 1 divided by 4 times 2 is 50%. I ignore the residual value in double declining balance. It's the only method you ignore the residual value for. So I take my book value of $24,000, so cost minus accumulated. I have nothing in accumulated so far. So $24,000 minus divided by, $24,000 times 50%. 1 divided by the life, 1 divided by 4 times 2. So $24,000 times 50% is $12,000. Now, when I do it again, remember my book value is now $12,000. $24,000 in delivery truck minus the $12,000 in accumulated depreciation. Next one, I purchased a new truck for $50,000 cash, so I debit delivery truck in cash. Paid the garage $250 to tune the engine and make other minor repairs. Again, that does not significantly increase the value of the truck or increase its useful life, so I take it to an expense account. Next one, I sold the used truck, so this one's the used truck, for $9,500. Record the depreciation to date in year 2 for the truck, so I'm going to pause this a second. Okay. So we sold the truck for $9,500. It says record the depreciation to date in year 2 for the truck. So notice that in my first year, I've got my computation. I have my $24,000. I have my rate, which is 1 divided by the life times 2. So its life was 4. So 1 divided by 4 is 25%. Times 2 is 50%. So my depreciation expense is $12,000. And my accumulated is $12,000. In year 2, I take my book value, which is the cost minus the accumulated depreciation, so it's $12,000. I have a rate of 50%, so I take $12,000 times 50%, so I have $6,000. However, I sold it on April 30th. So I need just January, February, March, and April. So I need 4/12 of that amount. So I have $2,000. So now my accumulated is 14,000. So notice the first thing I do is debit depreciation expense and credit accumulated depreciation for $2,000. Now I sold it, so I can't remember what I sold it for. Sold the truck for $9,500, okay? So when I sell a truck or anything, what I do is I do a couple things. The first thing is I get the truck off my books. So notice that I need to figure out which truck I sold, the $24,000 one or the $50,000 one, and I sold the $24,000 one. The problem just tells me. So notice I debited delivery truck. So now I'm going to credit delivery truck, if I can spell, for what I have it on my books for. So for $24,000. Okay, so now if I made a T account of a delivery truck, it's gone. However, every fixed asset has two accounts on it, so I've got my accumulated depreciation for that delivery truck also, which I said is $14,000. Okay, so I'm getting the truck off my books, and to get the truck off my books, I need to get both accounts off. The delivery truck has a debit, so I get it off with a credit. The accumulated depreciation has a credit, so I get it off with a debit. So notice it says $12,000 plus the $2,000 there. So my accumulated is that. The next thing I'm going to do is record the cash, and I believe I sold it for $9,500. So I got, cash went up for $9,500. And now I simply look at it and figure out, do I need a debit to balance or do I need a credit to balance? If I look at this, I have $23,500 on my debit side and $24,000 on my credit side. So I need a $500 balance in my debits to make my two sides equal. If you have a debit to balance, it's a loss. So I have a loss on my sale. So I debit accumulated for $14,000, debit cash of $9,500, credit delivery truck for $24,000, and I have a debit a loss of $500. So that's those journal entries. Next one, I purchased a new truck for $58,500, paying cash. So I got cash and delivery check. Next one, I sold the truck purchased on January 9th, year 2 for $36,000. Record the depreciation to date for year 3 of the truck. So let me pause this. So now we sold the truck we purchased in year 2. But what I did forget to do was record the depreciation on the new truck. Okay, so the new truck, you probably need to keep track of these, of new truck, used truck, and another new truck. So new truck number 2, okay, or truck number 2. Truck number 1, truck number 2, truck number 3. So this is truck number 2. $50,000. So I need to record the depreciation on it. So it is double declining balance, and double declining balance, I don't use residual value in my computation. However, my book value will be it at the end. So I have $50,000. My rate is 1 divided by the life, which is 8 years, times 2. So I have 25%. So my depreciation expense is $50,000 times 25%, so $12,500. So you can see that I have depreciation expense and accumulated depreciation of $12,500. Then in year 3, I bought a new truck. I sold this truck right here, and then I recorded depreciation on the $58,000 truck. So we'll come to that, back to that one in a second. But the first thing I need to do is, I sold it on September 4th, so I've already recorded this $12,500. In year 2, it's book value, so $50,000 minus my accumulated depreciation. I take my $37,500 times my rate of 25%. But now, I didn't own it the whole year, so I need sold it on September 1st, so I have 9 divided by 12. If I can get this. So I have $7,031.25. So let me see how much they took there. They round it. Okay, so now if I could count my months correctly, I sold it on September 4th, which is the 9th month, but I only owned it through August, so I'm going to have 812. So 93 times 8 divided by 12 of 6250. So my debit is depreciation expense, credit accumulated depreciation for 6250. So this is kind of important here. I first get delivery truck off my books. My delivery truck is on my books. $50,000. I could scroll up and see that I've got delivery truck on my books for $50,000. I also get the accumulated depreciation off my books. My accumulated depreciation is on my books for $18,750, which is just the 2 years I've taken. I sold it for $36,000 cash. So now I have to see, I'll add them both up. What do I need to balance? Do I need a, do I need a debit or credit to balance? Well, you notice I need, this side, the credit side needs to go up by $47.50. So now I have my debits equal my credits, and if you need a credit to balance, it's a gain. Okay, so look at your journal entry down here. Cash is $36,000. Accumulated depreciation is $18,750. I credit delivery truck for $50,000, and I debit or credit gain for $47.50. So it's simply a matter of get the equipment off your books, get the accumulated depreciation off your books, record the cash, and then plug the difference if you need a debit to balance. Debits are like expenses, losses are like expenses, so if you debit it, it's a loss. Gains are a revenue, so if you credit it, it's a gain. And then the last thing we have to do is get our depreciation on the newest delivery truck, which is $58,500. I'll have to scroll back up and see what I have here. Purchased a new truck for $58,500, paying cash, so I have my book value of $58,500. It's on September 1st. Has an estimated residual value of $16,000. I do not use residual value in double declining balance, but it has a life of 10 years. So I have 1 divided by the life times 2, so I have 20%. So my depreciation expense is, but notice in this case I didn't buy it until September 1st. So I have depreciation for September, October, November, December. So I have $3,900 of depreciation. That's on the other asset. So my journal entry is to debit depreciation expense and credit accumulated depreciation for $3,900.